Most people think the hardest part of building wealth is finding the next extraordinary investment. I do not believe that is true. In my experience, the hardest part is getting money to stop behaving like a tired employee and start behaving like a productive machine. If you wake up early, spend time getting to work, give the world 8 or 10 hours of your attention, then fight traffic back home, you understand what it feels like to work for money. Your body works, your mind works, your calendar works, your paycheck arrives because you used your energy, your time, and your discipline. But then a strange thing happens. The money you work so hard to earn often does almost nothing. It sits in a checking account, it sits in a bank account, it earns a tiny amount of interest. It looks safe because the number is visible and stable. But in reality, if inflation is rising faster than the interest you earn, the money is not resting, it is quietly shrinking. That is one of the most important principles I learned about money. Risk is not only the thing that moves up and down on a screen. Risk is also the thing that looks calm while your purchasing power is being taken from you 1 year at a time. When people ask me how to start investing, they often expect a complicated answer. They think I am going to talk about day trading, screens, predictions, the newest stock, or some clever move that requires them to become a professional investor. That is not where I would begin. I would begin with a simple question. If you had $10,000 right now, would that money be working for you or would it be sleeping? That is the question that matters, because $10,000 is not just a number. It is a threshold. It is big enough to create structure, but still small enough that many people can reach it. It is enough to build a system. And once a system exists, money stops being random. The goal is not to become a genius. The goal is to stop making unforced errors. That is how serious wealth is often built. It is not built by excitement. It is built by repeatable behavior, controlled risk, and the discipline to let time do what time does. I know many people become anxious the moment they hear the word investing. They imagine sitting in front of a computer all day, staring at charts, waking up in the middle of the night because some market in another time zone moved down. They imagine that investing means stress. But if your investments are keeping you awake at night, that is not a system. That is a bad design. A good allocation should feel much more like setting a machine in motion. You choose the settings, you understand the purpose. You know what role each part plays, then you let the machine run. You do not stare at a washing machine for an hour to make sure the clothes are being cleaned. You set the cycle, press start, and allow the process to work. Investing, when done properly, is similar. It should not consume your life, it should support your life. That is why I want to think about the first $10,000 as a framework, not as a gamble. If you left that $10,000 in a bank account, it might feel safe. If you locked it in a low-yield deposit, it might feel responsible. If you put it into an insurance-style savings product, it might feel conservative. But the question is not whether it feels safe. The question is whether it is actually preserving and increasing your real purchasing power. A bank balance can be an illusion of safety. If inflation is running faster than your deposit yield, you are not standing still. You are moving backward in real terms. $10,000 still looks like $10,000 on the screen, but over time what it buys can quietly decline. That is not a dramatic crash. It is worse in some ways because it happens quietly. People fear volatility because volatility is visible. They underestimate inflation because inflation is distributed across groceries, utilities, insurance, rent, medical bills, repairs, transportation, and everything else that makes up life. That is why one of the most dangerous financial beliefs is that saving is always safe and investing is always dangerous. Saving is necessary, cash is necessary, but cash is not meant to do every job. Cash is like oxygen. You need it to breathe, but you do not build a house out of oxygen. The first myth is that investing is dangerous while saving is safe. The more accurate way to think is this: saving protects you from emergencies. Investing protects you from long-term erosion. They are different tools for different risks. The second myth is that you need a huge amount of money before investing matters. That sounds logical, but it is also the reason many people never begin. They say, I will start when I have 100,000. I will start when my income is higher. I will start when the economy is calmer. I will start when the market feels safer. But the market almost never feels safe. Life almost never becomes perfectly calm. And the habit that builds wealth is not created at the finish line. It is created at the starting line. $10,000 is a powerful starting line because it is enough to divide into roles. It lets you create a safety buffer, a growth engine, and an opportunity reserve. That is what turns money from a pile into a system. Think of it like going to the gym. You do not refuse to exercise because the weights are not heavy enough. You begin with what you can handle, you build form, you build routine, then the weights can increase. Money works the same way. The first goal is not to impress anyone. The first goal is to become the kind of person who has a system. The third myth is that investing means constant research, constant trading, and constant prediction. That is usually wrong for normal people with normal jobs. If you are a professional investor, you may need to spend your day examining businesses, markets, balance sheets, liquidity spreads, and probabilities. But if you work a full-time job, the best use of your time may not be spending 3 hours trying to guess which stock will move next week. Your time may be better spent improving your skills, increasing your income, spending time with your family, protecting your health, and letting a simple low-cost portfolio do its job. The principle is simple. Do not try to beat the entire market every month. Join the broad forces that have created wealth over long periods of time. That is the essence of passive investing. It is not laziness in the bad sense. It is humility. It is accepting that markets are complex adaptive systems and that most people who try to outsmart them repeatedly end up paying a tax in the form of fees, mistakes, emotional decisions, and bad timing. There is a kind of laziness that is destructive, and there is a kind of simplicity that is intelligent. What I am describing is intelligent simplicity. Now, why does the $10,000 milestone matter so much psychologically? Because for many people, it is the first time money begins to feel like an asset rather than a temporary visitor. If you earn a paycheck and every dollar is already spoken for, money feels like water passing through your hands. It arrives, it leaves, it has no permanence. But when you have $10,000 assigned to a system, something changes. You begin to see that money can produce more money. Assume a 6% annualized return on $10,000. That is about $600 a year, or around $50 a month. $50 a month will not change your life immediately. It will not pay your mortgage. It will not make you rich overnight. But that is not the point. The point is that the $50 did not come from you working another shift. It did not come from you selling more hours. It came from capital. That is the beginning of a very different relationship with money. The first time a dividend arrives in your account, or the first time you see market growth that did not require another hour of labor, you begin to understand the difference between earned income and capital income. Earned income depends on your labor. Capital income depends on ownership. The sooner you understand that distinction, the sooner you start organizing your life around building ownership. But there is a major problem. Most people do not fail because they lack information. They fail because they lack a system. They watch a video and buy something. They hear a friend mention a fund and follow it. They read one article and become excited. Then they stop, or they buy at the wrong time. Panic during volatility, sell at a loss, and decide investing does not work. That is not investing, that is reacting. A system solves that problem because it tells you what to do before your emotions get involved. The system I would use for a first $10,000 has 3 layers. Each layer has a job. When money has a job, you stop treating every dollar the same. The first layer is the safety net. I would set aside 20%, which is $2,000, and I would not invest it in the stock market. This money exists to protect the rest of the system. It belongs in a high-yield savings account, a money market account, a short-term deposit, or a similarly liquid place where you can access it when life happens, and life will happen. A pipe breaks, a tire fails, a medical bill appears, a laptop dies, a client disappears, a job becomes unstable, a family member needs help. If you do not have a safety net, emergencies force you to liquidate growth assets at the worst possible time. That is how people lose. They buy investments when life is calm, then a crisis comes. The market is down, they need cash, they sell at a loss, then the market recovers without them. The mistake was not necessarily the investment. The mistake was not having a safety layer. That $2,000 may feel like wasted money because it will not generate high returns. But that is the wrong comparison. Its purpose is not high return. Its purpose is psychological and operational resilience. It gives you the ability to stay invested. That is worth a lot. In markets, survival matters more than brilliance. The people who can stay in the game often beat the people who try to win the game quickly and get forced out. The second layer is the growth engine. This is the core of the plan. I would allocate 60% of the $10,000, which is $6,000, to long-term growth. This is where the money begins to work. In a simple version, I would divide that $6,000 between broad stock market ETFs and bond ETFs. One practical structure is 70% in broad equity exposure and 30% in high-quality bonds or investment-grade bond funds. That means out of the $6,000, about $4,200 goes toward broad stock market exposure, and about $1,800 goes toward bonds. The stock portion represents growth. Over long periods, broad equity markets have historically produced higher returns because they represent ownership in productive businesses. Businesses create goods and services, raise prices, innovate, generate profits, and compound value. The bond portion represents stability. Bonds usually do not offer the same upside, but they can reduce the emotional and financial shock of downturns. They can dampen volatility and provide a stabilizing counterweight. This combination is not designed to maximize bragging rights. It is designed to help you stay with the plan. A portfolio that is too aggressive can destroy your behavior even if it looks optimal in a spreadsheet. If a 100% stock portfolio falls 35% and you sell in panic, the theoretical return did not matter. The real portfolio is the one you can actually hold. That is why balance matters. Stocks help the portfolio grow. Bonds help the investor survive the ride, and the investor surviving the ride is the key. The next issue is timing. People want to buy at the perfect moment. They want the bottom. They want certainty. They want someone to tell them the market will not fall next week. That is not how markets work. Even the professionals cannot reliably identify bottoms in real time. They can explain them later. But explaining the past is easier than executing in the present, so I would not put all $6,000 to work on one emotional day. A more practical approach is dollar cost averaging. Divide that growth allocation over several months. For example, invest $1,000 a month for 6 months. That way, if the market drops after the first purchase, the next purchase occurs at a lower price. If the market rises, you are still participating. This approach does not guarantee the best mathematical outcome. Sometimes investing immediately would have produced higher returns, but dollar cost averaging can reduce regret and help a new investor build the habit without becoming paralyzed by timing. For many people that matters. The third layer is the opportunity reserve. I would keep the final 20%, another $2,000, as flexible cash. This is not the same as the emergency fund. The emergency fund is for life. The opportunity reserve is for markets. It is dry powder. Its job is to allow you to buy when fear creates better prices. The rule must be defined before the market falls. If you wait until panic arrives, you will not think clearly. One simple rule is this: if the broad market falls more than 15% from its recent peak, begin deploying the opportunity reserve in portions. Do not spend it all at once. Deploy in batches. A market that falls 15% can fall 25%. A market that falls 25% can fall 35%. The goal is not to guess the exact bottom. The goal is to have a process that turns fear into action. That is the psychological value of dry powder. When everyone else is panicking, cash lets you think. Without cash, a market crash feels like a threat. With cash, a market crash can feel like an opportunity. That does not mean crashes are pleasant. They are not. Watching your account fall is difficult. But difficulty does not mean danger if your system has prepared for it. In 2022, many investors felt pain because markets fell sharply. But disciplined investors who had cash, income, and a plan were able to buy assets at lower prices. When markets recovered, those purchases mattered. This is how cycles work. The public wants safety when prices are high and opportunity when prices have already recovered. A better system prepares before the cycle turns. Now, a person hearing this may say, this still sounds complicated, but the execution is simpler than the explanation. The first step is to open a brokerage account. That does not need to be dramatic. Most major brokerages allow accounts to be opened online. The more important questions are fees, reliability, ease of use, and whether you can buy low-cost ETFs without unnecessary friction. Do not overcomplicate this. The account is the container, the system is what matters. The second step is to set automatic transfers. This is critical because discipline should not rely entirely on mood. Human beings are inconsistent. We get busy, we procrastinate, we get scared, we forget. We tell ourselves we will do it next week. Automation reduces that risk when money moves automatically from income into the system. The system becomes part of your financial life rather than something you need to remember. This is similar to a mortgage payment, a utility bill, or a retirement contribution. After a while, you stop debating it, it becomes normal. That is powerful. The third step is to choose the investments. If you do not know what to choose, keep it broad. A total U.S. market ETF, a global stock ETF, or an SP 500 ETF can be a reasonable starting point for the equity side. Examples often mentioned are VTI, VOO, or VT. The goal is not to find the single perfect fund. The goal is to own a diversified basket of productive businesses at low cost. For bonds, the idea is similar. You want broad, high-quality exposure rather than taking unnecessary credit risk you do not understand. The principle is that the portfolio should be boring enough that you can keep it. Excitement is often expensive. The fourth step is to rebalance. This is where many people lose the discipline. Suppose your target is 70% stocks and 30% bonds. After a strong year for stocks, your portfolio might drift to 80% stocks and 20% bonds. At that point, Rebalancing means selling some of what went up and buying some of what lagged, bringing the portfolio back to 70 and 30. This feels counterintuitive. The part that went up feels like the winner. The part that lagged feels like the loser. But rebalancing imposes discipline. It forces you to avoid letting yesterday's winner become tomorrow's excessive risk. It is a systematic way to sell relatively high and buy relatively low. You do not need to rebalance every day. You do not need to rebalance every week. For many people, once or twice a year is enough. The purpose is not perfection. The purpose is risk control. The fifth step is to keep learning without overreacting. You should understand what you own. You should learn how inflation works, how interest rates affect bonds, how earnings affect stocks, and how cycles influence behavior. But learning is not the same as tinkering. Some people confuse motion with progress. They constantly adjust their portfolio because they believe activity means intelligence. Often it means anxiety. Retail investors frequently underperform the market, not because they lack access to good funds, but because they trade too much, react too much, and let emotions set the schedule. A good investor can look inactive from the outside, but inside the system, discipline is active every day. Now, what can this kind of structure become? Assume a 70% stock and 30% bond portfolio earns somewhere around 6 to 8% over long periods. That is not guaranteed. Nothing in markets is guaranteed. But it is a reasonable historical range for thinking about how compounding can work. At a 7% annualized return, $10,000 becomes close to $20,000 in 10 years. In 20 years, it becomes more than $38,000. In 30 years, it becomes more than $76,000. And that assumes you never add another dollar. But real wealth is usually built by adding consistently. If you start with $10,000 and then invest $200 a month over 30 years, at similar assumptions, you can build a portfolio of more than $300,000. That is the part many people underestimate. The first $10,000 matters, but the system that follows matters even more. The initial capital gives the system weight. The monthly contributions give it momentum. The returns give it compounding together. They create the machine, and the machine is the point. This is why I say the lazy way is not about doing nothing. It is about doing the right things once, then allowing them to repeat without constant drama. There will be downturns. There will be years when the system feels disappointing. There will be headlines that make you question everything. There will be moments when your account is down 20% or more. If you invest for decades, you should expect this. Market declines are not exceptions. They are part of the system during the pandemic crash. In 2020, markets fell quickly. Many people panicked. Some sold, some froze, some abandoned their plan. But those who understood their allocation, had enough cash, had bonds as a cushion, and kept buying, were able to stay grounded. The market eventually recovered. The pain was real, but the process survived. That is what you want. You do not want a strategy that only works when conditions are pleasant. You want a strategy that you can still follow when conditions are ugly. That is why your biggest enemy is usually not the market. It is your own reaction to the market. Markets fall, recover, overshoot, disappoint, surprise, and repeat. Your job is not to control the market. Your job is to control your behavior. That is the value of a system. A system makes decisions before the emotional moment arrives. When prices fall, your system tells you whether to rebalance or deploy opportunity cash. When prices rise, your system tells you not to become greedy and abandon risk controls. When headlines get loud, your system tells you to return to fundamentals. And when nothing exciting is happening, your system keeps compounding quietly in the background. That is how money works while you live your life. But I would also be careful not to make investment returns your only wealth-building engine. Your human capital may be the most important asset you have. If you are 30 years old and earn $60,000 a year until 65, that is more than $2 million of salary over your remaining working life, even before raises. If you improve your skills and increase your income, the effect can be enormous. A portfolio compounds capital. A career compounds earning power. The two should work together. If you invest $10,000 but ignore your skills, your income may remain too low to feed the system. If you raise your income but never invest, your money keeps passing through your hands. The ideal situation is to do both, improve your ability to earn, then direct part of that increased income into assets that can compound without you. This is where many people miss the bigger picture. They obsess over whether a fund returns 7% or 8% while ignoring the fact that increasing income by $20,000 a year could give them far more capital to invest. One person might begin with $10,000 and invest modestly. Another might begin with the same $10,000 but also work hard to increase skills, negotiate better compensation, move into a higher value role, or build a business. If that person's income doubles, their annual investing capacity can change dramatically. The portfolio then grows faster, not because they discovered a secret fund, but because they increased the fuel going into the machine. That is how the system becomes powerful. So if I were sitting with a person who had $10,000 and wanted to build wealth without turning life into a trading desk, I would bring them back to the same principles: preserve enough cash so emergencies do not force bad decisions, invest the growth portion broadly and consistently, keep an opportunity reserve so volatility can become useful, automate the behavior so discipline does not depend on mood, rebalance so risk stays aligned with the plan. Improve your own earning power so you can feed the system more aggressively over time. This is not exciting in the way gambling is exciting. It is exciting in the way freedom is exciting, because the purpose of money is not just to become rich. The purpose of money is to increase the quality of your choices. When your money starts working, you become less dependent on every single paycheck. You gain room to think. You gain room to make better decisions. You gain room to say no to bad opportunities and yes to good ones. That is what real financial progress feels like. It is not just a bigger number, it is more control. And control is one of the most valuable assets in life, if you do nothing. Inflation continues anyway, costs continue to rise. Your money continues to lose purchasing power quietly. Waiting does not remove risk. It simply chooses a different risk. The risk of investing is volatility. The risk of not investing is erosion. You must decide which risk you are willing to manage. For most people with a long time horizon, a stable income, and enough cash reserves, the better risk to manage is volatility. Volatility can be planned for, it can be buffered with allocation, it can be reduced with diversification, it can be endured with time. Erosion is harder because it happens even when you feel safe. That is why the best time to build the system was years ago. The next best time is when you understand the need for it. You do not need to feel completely ready. Most people never feel ready. There is always a reason to wait. The economy is uncertain, the market feels high, the market feels low, interest rates are confusing, the news is frightening, someone says a crash is coming, someone else says a boom is coming. If you wait for perfect certainty, you will be waiting forever. The point is not to eliminate uncertainty. The point is to build a structure that can operate inside uncertainty. That is what serious financial planning is. It is not prediction, it is preparation. $10,000 may not look life-changing at first, but it can be the point where your financial life changes direction. It can be the moment you stop letting money sleep and start assigning it to work. It can be the start of a system that creates more options every year. The number itself is not magic. The behavior it creates is what matters. Once you see that your money can produce money, you begin to think differently. You become less interested in wasting it. You become more interested in protecting it, assigning it, compounding it, and using it to build freedom. That is the shift. At first, you work for every dollar. Then, if you build the system correctly, some of those dollars begin working for you. And over enough time, the dollars working for you can become more important than the dollars you worked for. That is how financial independence begins. Not with drama, not with prediction, not with a lucky trade, but with a simple system repeated long enough for compounding to reveal its power. So if you have $10,000, do not let it drift, do not let it sleep, do not let inflation quietly eat it. Give each part a job. Build the safety net, build the growth engine, keep the opportunity bullets ready, automate the process, rebalance with discipline, keep learning without overreacting, and keep increasing the earning power of the person behind the portfolio. That is how the lazy way becomes powerful. It is not lazy because it lacks thought. It is lazy because once the thought is done, the system can keep working without needing your attention every day. And that, in the end, is the real objective: to stop chasing money every waking hour, to build a machine that quietly compounds in the background, to create the freedom to spend your best energy on the things that matter most. Your health, your family, your work, your principles, your life. Because money is not the end goal. Money is a tool that helps you design a life with more choices, less panic, and a better relationship with time. And time is the asset you can never earn back once it is gone.